If you buy a stock, you are buying a fractional ownership stake in a company and a legal claim on its future cash flows. If you buy a cryptocurrency, what are you actually buying? For 90% of retail investors, the answer is just a ticker that might go up. But in 2026, the market is ruthless. The days of buying a random protocol just because of hype and a flashy white paper are largely over. If you do not understand a project's tokenomics, its monetary policy, distribution, and value accrual mechanisms, you are simply providing exit liquidity for the developers and venture capitalists who do. This guide breaks down how tokenomics actually works, the math behind valuations, the mechanics of supply and demand, the low-float trap that destroys portfolios, and how to identify whether a token actually captures the value of the network it represents. The math of valuation price is a distraction. The single biggest mistake beginners make is unit bias. They look at a token priced at $0.0001 and think, if this just goes to $1, I'll be a millionaire. Price in isolation is a meaningless metric. To understand a token's true size, you have to look at its supply. There are 3 supply metrics you must track. Circulating supply, the number of tokens currently trading on the open market. Total supply, the amount of tokens that currently exist, including those locked in smart contracts. Max supply, the absolute hard cap on the number of tokens that will ever exist if one is coded into the protocol. These numbers give us our 2 most critical valuation metrics. The first is market capitalization, which represents the current size of the asset today. Dollar market cap equals price times circulating supply dollar. The second, and far more important metric for long-term investing, is the fully diluted valuation, FDV. This represents what the project would be worth today if all tokens that will ever exist were unlocked instantly. Dollar FDV equals price times max supply dollar. The low float, high FDV trap. The defining toxic trend of the 2021 to 2024 era, which the 2026 market heavily penalizes, is the low float, high FDV token launch. Here is how the trap works. A team launches a token but only releases 5% of the max supply into circulation. Because the circulating supply, the float, is so tiny, it takes very little buying pressure to pump the price. The token hits $10. At a 5% float, the market cap might look reasonable, say $500 million, but the FDV is an astronomical $10 billion. Over the next 2 years, the remaining 95% of the tokens unlock and flood the market. Even if the project is wildly successful and the market cap doubles to $1 billion, the massive increase in supply means the price of the individual token will crash by 80%. As an investor, your portfolio is bleeding out while the protocol itself is growing. If the FDV is completely detached from reality, avoid the token. Supply mechanics, inflation, deflation, and sinks. Once you understand the baseline supply, you have to look at the monetary policy. How does the supply change over time? Absolute scarcity. Bitcoin is the prime example. The max supply is hard-coded at 21 million. No developer can change this. The emission rate, new Bitcoin mined, halves every 4 years, creating predictable, diminishing inflation. Deflationary mechanics. Ethereum introduced the concept of dynamic deflation via EIP 1559. Every time someone transacts on Ethereum, a base fee of ETH is permanently destroyed, burned. If the network is heavily used, more ETH is burned than is issued to validators. The total supply shrinks. True deflationary mechanics are incredibly bullish for long-term holders, but only if there is organic demand driving the burns. Inflationary farming. Many DeFi protocols print new tokens continuously to reward users for providing liquidity. This is an inflation tax on all existing holders. If a protocol is paying you 50% APY in their native token, but the token's supply is inflating by 100% a year, you are losing purchasing power. To combat inflation, protocols build token sinks mechanisms designed to lock tokens out of circulation. This could be requiring users to lock tokens for months to boost their yields, or requiring tokens to be staked to operate a network node. A good token model balances its emissions with equally strong sinks. Demand drivers, the value accrual problem. Why would anyone buy the token on the open market? If the only answer is speculation, the token is fundamentally weak. In 2026, we categorize tokens by how they capture value. Layer 1/gas tokens, the strongest demand driver. To do anything on Ethereum, Solana, or Base, you must spend their native token to pay for block space. As long as developers are building apps on the network, there is intrinsic guaranteed demand for the token. Revenue sharing, real yield. Modern DeFi protocols operate like software businesses. A decentralized exchange or a perpetual futures platform charges trading fees. Protocols with real yield tokenomics take those fees, often paid in stablecoins like USDC or ETH, and distribute them directly to token holders who stake their assets. You are earning a dividend based on actual protocol revenue, not inflationary printed tokens. Governance. Historically, many protocols launched tokens that granted nothing but voting rights on protocol upgrades. Unless there is an explicit plan to turn on a fee switch to distribute revenue to voters, pure governance tokens are effectively meme coins with a corporate aesthetic. The market heavily discounts them today. Distribution. Who holds the power? Finally, you must look at the token allocation pie chart. Who got the tokens before they were listed on an exchange? If 50% or more of the supply is allocated to the core team and early venture capitalists, the project is highly centralized. You need to read the vesting schedule. VC tokens are usually locked via smart contracts for 12 to 24 months. There are two types of unlocks. Linear vesting means a tiny fraction of tokens unlocks every day. This is healthy and manageable. Cliff unlocks mean a massive chunk of supply becomes liquid on a single specific date. If you hold a token heading into a massive VC cliff unlock, you are likely to be the exit liquidity, as early investors dump their bags to lock in 100x profits. In 2026, tracking unlock dashboards is a mandatory part of trading. Tokenomics is the physics engine of a cryptocurrency. A great product with terrible tokenomics will ruin its investors. A mediocre product with brilliant tokenomics can survive for years. Always read the math before you read the hype.